So in the previous modules, we went over fair value gaps and we also went over the session liquidity. So what exactly are we going to be going over in this video? We're just going to be going over how to put them together. I'm going to show you a simple, clear as day example of how you're using the fair value gaps that we learned about, and the inversion fair value gap, which is actually the entry trigger that we need to actually be successful with this model. So, for example, what have we gone over in the course? If you remember, what we've done is we've learned how to mark out our session opens, right? So for example, 1 a.m. is London session, and then 19 is Asia session, and then 7 a.m. is New York session. So this is to show you that this model works for all sessions, right? I'm going to show you an example during London session. If you were trading London session, this is how you would do it. If you were trading Asia session, this is how you would do it. If you were trading New York session, this is how you would do it. So if I drop down to the 5-minute time frame, right? Where is Asia session's high? Asia session's high is up here. Boom, that's marked. Where's Asia session low? Asia session's low is down here. Where is New York session high? Guys, this right here is New York session's high. Why? It doesn't matter. This is the highest point ever in New York session. That is the high we're going to use. Where's New York session low? New York session low is down here. Boom. Now, what do I want to see? We already talked about the model. This is something that we would like to see. This is the exact model. Reaction off of Asia session high or London session high, New York session high, I'm sorry, some type of liquidity sweep with an inversion fair value gap. So we're waiting, boom, we got our liquidity sweep right here. Is there any inversion over here? I don't see any, so we're waiting. We need a 5-minute FVG to form. Would you look at that? 5-minute FVG. Guys, we just talked about it. What is price supposed to do with this fair value gap? It's supposed to actually be able to send price higher, but instead what happens? We end up inversing it. This is a trade setup. Short position. Now, where do you put your stop loss and where do you target for TP? If you want the safest stop loss possible, you can put your stop loss above the swing high. If you want the tightest stop loss, but the most riskiest, you can put your stop loss above the candle that did the inversion. That will give you the tightest stop loss, but it's the most riskiest. Price can just wick you and continue going in your direction. If you put your stop loss above the candle's high, then you're Gucci. So what did we do? We waited for a sweep of a session liquidity, got an inversion of a fair value gap that's on the 5 minutes, got into the trade off of the inversion, placed our trade, placed our stop loss. Where are we targeting? The first easiest target is the most recent swing high, but ultimately you want to be targeting from session liquidity to session liquidity. Now, do I think price is actually going to go here? No. In our next video, I'll be talking to you about bias and how you can actually create a bias. Do I think this is possible? Yes, but do I think it'll happen? No. You have to put this into context. We just made this massive move. We might not get a move that much lower. And what happens? Price dumps. First TP. I think that's all it gave us. Could have created TPs along the way. Boom. First TP. What is this? Made this another TP. Second TP. What is this? What did price ultimately give us? Even though we didn't get the session liquidity all the way down here, this trade still gave us a 1 to 3 RR. You're being greedy. That's more than enough. But guys, if you had done the riskier option, you put your stop loss above the candle. This is a 129 risk to reward ratio. It is gold. Gold will give you this. I just had to show you how to put the session liquidity model along with the entry model, fair value gaps and inversion fair value gaps combined together to place a trade. This is how you would do it, and this is where you would put your stop loss and where you will put your take profit. Take profit, I want you to target swing lows, not internal lows. No, swing lows. A lot of y'all would have gone break even here. This is not a swing low. This is an internal low. If you went break even here, it probably would have tagged you out because you know with spreads and everything, you probably didn't get filled to here. Don't move stops to break even until you've partialed at first TP. And first TP is always at a form of external low. This is an external low. Once here got taken, now I can go break even. Till then, no break even. And with that being said, man, that is pretty much the session liquidity model. Simple, right? Yeah, but why did it take me 2 years after finding the simple model to still become profitable? Because it's the systems that I had to add in place. Going break even, like I just showed you, when I shouldn't be. Over leveraging when I shouldn't be. My strategy is not enough. I want you to know this, hopefully, because no other person in the industry will tell you this. Yes, man, my strategy will make you profitable. Buy my course. No, nobody will tell you that. I'm giving you my strategy away for free because I'm telling you, brother, it's not enough. I wish it was. I've simplified it to the best way I can, but the failure rate is still high. Why? Because you need to start implementing systems into your trading. If you don't implement systems into your trading, every businesses have systems, SOP, standard operating procedure. Treat trading like a business, implement your own SOP, and you will be successful. Catch your boys in the next video.